Hey everyone, welcome back to Corporate Decoder. Today, Hooker Furnishings Corporation just filed their quarterly report for the period ending May 3, 2026, and I'm seeing signs of their strategy to become leaner finally paying off. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a strong comeback in profits despite a slight dip in sales, and their financial health looks more stable than in the past. Let's dive into the numbers. Looking at the balance sheet as of May 3, 2026, a few things stand out. Total assets are around $223 million. What is interesting is the significant jump in cash and cash equivalents, which is up to over $10 million, a big leap from just over $1 million at the start of the year. This usually means they're either generating more cash or borrowing less, and it is a good sign for their ability to handle unexpected expenses. Now, let's look at how they performed in the first quarter of 2027 compared to the same time last year. Net sales actually decreased slightly, falling to about $69 million from nearly $71 million in the prior year. However, the cost of sales dropped even more significantly, from over $53 million down to about $48 million. This is great news because it means their cost to produce or acquire the goods they sell went down a lot. This led to a much higher gross profit. Gross profit jumped to over $20 million, a nice increase from about $17 million in the previous year. This improvement in gross profit is a key indicator that the company is becoming more efficient in how it manages its costs relative to its sales, and the impact on their operating income is substantial. They reported an operating income of about $1.6 million for the first quarter of 2027, a huge improvement from an operating loss of almost $500,000 in the same period last year. This nearly $2.1 million swing directly reflects their improved cost management and higher gross margins. This translated into net income from continuing operations of over $1 million, a big turnaround from a net loss of over $600,000 last year. For the entire company, including discontinued operations, they posted a net income of $1.1 million compared to a significant net loss of over $3 million last year. This is a crucial turnaround, showing they are moving away from losses and towards profitability. It is worth noting that last year there was a loss from discontinued operations of about $2.4 million, which has now been resolved with the sale of those businesses, as mentioned in the notes. So, this year's results are cleaner and more reflective of their ongoing business. Let's see where the cash is coming from and going. In the operating activities section, cash provided by operating activities was around $14.4 million for the first quarter of 2027. This is a solid amount though, slightly less than the $19.2 million from the prior year. The slight decrease in operating cash flow was mainly due to less favorable changes in how they managed their short-term assets and liabilities, like receivables and inventory. Investing activities provided a small amount of cash this quarter, just about $21,000, which is much better than the nearly $850,000 that was used up in the prior year. This change is largely because they received some money from life insurance policies and spent less on buying new equipment. Financing activities show a bit more cash outflow this quarter, with over $4.9 million used. This was mainly due to repaying a significant portion of their loan, specifically around $6.7 million, while also paying dividends and buying back some company stock. All of this resulted in a healthy net increase in cash and cash equivalents of almost $9.5 million for the quarter, bringing their total cash to over $10.6 million. This is a very positive sign for their liquidity. Looking at the equity side, the common stock amount is fairly stable. Retained earnings are still substantial, showing accumulated profits over time, although they saw a slight decrease this quarter due to dividends paid and stock repurchases. The total shareholders' equity remains strong, indicating the company's overall financial stability. The notes reveal a key strategic move. The company completed the sale of its Pulaski Furniture and Samuel Lawrence Case goods brands in December 2025. This was a deliberate decision to focus on brands that generate consistent earnings. This sale eliminated the Home Meridian segment, and its results are now shown separately as discontinued operations. This streamlining is a core part of their strategy to become a more efficient business. Under intangible assets, the report details goodwill and trademarks. The company has recognized significant impairment charges from past acquisitions, particularly in fiscal years 2021 and 2025. While some of these prior impairments are listed, the current figures show the net value of these intangible assets, which is $12.4 million as of May 3, 2026. These figures reflect the ongoing impact of past strategic decisions on their balance sheet. For leases, both operating lease costs and liabilities have decreased. Operating lease costs went from $2.3 million last year to $1.8 million this quarter, and the total lease liabilities are now around $23.5 million, down from nearly $25 million at the start of the year. This shows a reduction in their long-term lease commitments. Regarding debt, the company has an amended and restated loan agreement with a revolving credit facility of up to $70 million. Importantly, as of May 3, 2026, there were no outstanding loans and only $3.2 million in face amount of letters of credit. This is a significant improvement from having $3.2 million in loans outstanding at the start of the fiscal year, indicating strong debt reduction efforts and improved financial flexibility. Earnings per share is a crucial metric for the first quarter of 2027. Diluted earnings per share from continuing operations was 10 cents. This is a remarkable turnaround from a loss of 6 cents per share in the prior year. This improvement is driven by higher profits and a slightly higher weighted average of diluted shares outstanding, but the key takeaway is the positive earnings per share. They also bought back some shares, 7615 to be exact, which reduces the total number of shares, which can make earnings per share look better. The company breaks down its operations into 3 segments: Hooker branded, domestic upholstery, and all other. Hooker branded saw sales decrease but a significant gross profit increase, showing better pricing power. Domestic upholstery had slightly lower sales and gross profit, impacted by its leather furniture division. All other, which includes hospitality, saw strong sales growth. The Hooker branded segment, which includes imported case goods and upholstery, saw net sales decrease by 4.8%. This was mainly due to lower sales volume in their imported upholstery line, affected by inventory issues and softer retail demand. However, average selling prices went up, helping to offset some of the volume decline. Domestic upholstery sales dropped by 1.9%. This segment experienced mixed results with strong private label sales, but a decline in upscale leather furniture. The all other segment, which includes hospitality and other businesses, showed a healthy 11.7% sales increase, driven by higher shipments in the hospitality sector. Overall, consolidated gross profit increased by 14.8%, reaching $20.6 million. The Hooker branded segment was the star here, with a 25.8% increase in gross profit and a massive 960 basis point improvement in gross margin. This was largely thanks to higher average selling prices. Consolidated selling and administrative expenses did increase slightly by 4% in dollar terms, but as a percentage of sales, they were a bit higher at 26.6% compared to 25% last year. This rise was primarily in the Hooker branded segment due to higher compensation and its costs. The significant improvement in gross profit, despite higher selling and administrative expenses, drove the impressive operating income of $1.6 million for the consolidated company. This is a massive turnaround from the operating loss of $498,000 last year. There are no major new accounting policies adopted that are expected to significantly impact their financials in the immediate future. The company flags interest rate risk due to its revolving credit facility, but with no outstanding loans, this risk is currently minimal. They also face risks from fluctuating raw material prices and currency exchange rates for imported goods, although they generally pass these costs on to consumers. The company states that their disclosure controls and procedures are effective, meaning they have systems in place to ensure that important financial information is properly captured and reported in a timely manner. They also recently started repurchasing shares. In the first quarter of 2027, they bought back over 7,600 shares for about $96,000, using part of a $5 million authorization. They still have about $4.9 million available for future share buybacks. This can help boost earnings per share and signal confidence to investors. Looking ahead, the outlook is cautious due to a weak housing market and hesitant consumers. Incoming orders in May did increase by 8% year-over-year, and backlog is up 14%, boosted by new Margaritaville product orders. However, the company anticipates potential new tariffs later this year. Despite these challenges, the company believes its more efficient cost structure and focused portfolio position it for improved performance as market conditions improve. Overall, Hooker Furnishings seems to be executing its strategy to become leaner and more profitable. The significant turnaround in operating income and net income, coupled with improved liquidity and debt reduction, suggests positive momentum. However, the ongoing macroeconomic pressures and tariff uncertainties remain key risks to watch. The company's success will largely depend on its ability to navigate these external factors, while continuing to manage costs effectively and capitalize on new product lines like Margaritaville. What stands out to me is the dramatic improvement in gross margins across the board, especially in the Hooker branded segment, showing a stronger ability to pass on costs or reduce them effectively. My biggest concern is the continued weakness in the housing market, which directly impacts furniture sales. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.